Welcome to Private Asset Management's first quarter update to our economic and financial market outlook.
The views and opinions expressed herein are as of the date recorded and should not be construed as an offer to buy or sell any securities. Such views and opinions may differ from those of Private Asset Management or its affiliates and are subject to change without notice. Private Asset Management has no obligation to provide updates or changes.
Economic growth slowed to 2.9% in the last quarter of 2017 from the better than 3% growth in the second and third quarters. Of particular note in the period was a much larger contribution made by the fixed investment category than we have seen over the last several quarters. Businesses have increased their investments, particularly investments in equipment in response to strong economic growth around the world. Another highlight is a strong contribution the U.S. consumer made to overall growth. Personal consumption increased 4% in the quarter, which was the best growth in the category in 3 years. Turning the page to the first quarter of 2018, we expect the first estimate of growth to show a slowdown when it is released on April 27th. This view is supported by a number of forecasts we track. Our view that growth slowed in the first quarter is based largely on a slowdown in consumer spending. Personal consumption accounts for roughly 70% of GDP and has been the driving force behind economic growth during the current recovery. Data from the first quarter shows that consumers increased their savings in January and February, thereby foregoing consumption in the period. This behavior, consumers replenishing savings after elevated spending during the holiday season, is not unusual. Moreover, with savings back to a comfortable level, we expect consumers will reassert themselves in the second quarter. One reason to be optimistic about consumption activity in the second quarter is that surveys of consumer sentiment and confidence continue to be recorded at or near cyclical highs. Shown here in red is the headline index of consumer sentiment, which, although it fell slightly in the most recent reading, remains at a very high level. Importantly, the survey historically tracks well with growth in consumption, shown here in black. Now, turning our attention to business spending, we expect investment activity continued to expand robustly in the first quarter. Core capital goods orders slowed in January before accelerating strongly in February, and over the last 6 months, activity has been some of the strongest in the current recovery. Recent ISM surveys of manufacturing and non-manufacturing industries indicate that business investment should continue to grow at an elevated pace in the current quarter. The very high headline readings from these indexes have been supported by strength in the new orders, production and employment sub-indexes. The labor market continues to add jobs at an impressive pace. The latest labor market report showed jobs increased by just 103,000, which was somewhat disappointing. We believe that this data point reflects a disturbance caused by cold weather on the East Coast more than a weakening labor market. For the first quarter of 2018, the labor market added an average of 202,000 jobs a month, which compares favorably with 2017 and 2016. All of these jobs being added has driven the headline unemployment rate lower and into territory rarely seen in the 70 years the data has been collected. We expect labor market gains in the coming months will result in unemployment reaching 4% and perhaps lower for the first time since late 2000. This exceptionally tight labor market should continue to support higher wages. In a recent survey of small business owners, 33% of respondents reported increasing employee wages in response to labor market tightness, the highest since November 2000. We expect higher wages to be transmitted through the economy as higher inflation this year. We have already seen consumer price inflation move higher towards the Federal Reserve's 2% target this year, as some of the transitory factors which had muted inflation over the last year have abated. With unemployment low and inflation trending higher, we do not foresee any obstacles that would cause the Federal Reserve to alter its current course of monetary policy normalization. Shown here in gray, the median policymaker expectation is that short-term interest rates will be increased 25 basis points, twice more this year, for a total of 3 increases in 2018. Moving on now to the housing market. Home prices continue to rise, in part because the inventory of available homes remains historically low. Mortgage rates are moving higher along with long-term rates in general, but remain very low from a historical perspective. Despite the increase in rates, home affordability is still supportive of a healthy housing market. We expect mortgage rates to continue moving higher in the coming months, but assuming wage growth accelerates as we expect, affordability should remain high. Touching briefly on the international economic environment, Global Purchasing Managers Index data shows a deceleration in global economic activity while still remaining in expansion. This recent deceleration may largely be a reaction to the trade barriers announced by the US and China. We expect that leaders in the US and China will negotiate over the next several weeks and that the ultimate size and impact of the announced tariffs will be greatly reduced. However, if negotiations fail and the announced tariffs are fully enforced, then global economic growth will surely slow as a result. Major market indexes had a bit of a bumpy ride in the first quarter. Early in the quarter, markets reacted negatively to higher than expected wage growth, which raised concerns about higher inflation in the US and a faster pace of policy normalization by the Federal Reserve. Those fears diminished over the balance of the quarter, but concerns about the rise of protectionist trade policies and their impact on global growth took their place, and price returns for the quarter were negative, with the exception of emerging markets. On a total return basis, the tech sector and emerging markets outperformed the S&P 500. The US large cap space was, unsurprisingly, the worst performer given their higher exposure to protectionist trade policies in the US and China. Consumer discretionary joined the tech sector as the only outperforming sectors in the S&P 500. Meanwhile, the traditionally high dividend paying sectors suffered from rising interest rates. The valuations of equity markets generally look more attractive following the first quarter pullback. The S&P 500 is back below the 75th percentile of monthly forward price to earnings ratios over the last 10 years, while US small cap and emerging markets are roughly at their 10-year averages. On a sector-by-sector basis, some valuations look particularly attractive. We continue to see the materials and energy sectors as the biggest beneficiaries of the higher rates of inflation we expect over the balance of 2018. In addition to valuations looking more attractive, we are expecting S&P 500 earnings growth to accelerate in 2018 from 2017. In fact, according to Bloomberg estimates, the only S&P 500 sector expected to see a slowdown in earnings growth is energy, which grew from a very low base following the decline in oil prices in 2016. Fixed income markets saw negative returns in the first quarter as rates increased across the maturity spectrum. The high yield corporate space, which tends to be low duration, saw the best performance, while A-rated corporates saw the largest negative return. U.S. 10-year Treasury rates continued marching higher in the first quarter, nearly reaching 3% in late February before retreating to 2.74% at quarter end. The march higher has resumed early in the second quarter, and the 10-year yield is now up roughly 50 basis points in 2018. With the increase seen in the first quarter, the 10-year yield has broken out of its long-term downtrend. This has some market commentators calling the end to the decades-long bull market in bonds. We expect long-term rates to continue moving higher in 2018, with the 10-year Treasury yield surpassing 3% as inflation trends higher. Despite long-term rates moving higher, the yield curve, depicted here as the difference between the 10-year and 2-year Treasury yields, has continued to trend lower. We believe the yield curve will continue to flatten in 2018 as short-term rates rise faster than long-term rates. The prospect of a flatter yield curve may make some investors fearful because an inverted yield curve, when short-term rates are higher than long-term rates, is viewed as an indication of an economic recession, depicted in this chart by the vertical gray bars. We note that historically the yield curve has remained flatter than it is currently for years before a recession occurred, as was the case for the entirety of the late 90s. We had viewed Treasury inflation-protected securities, or TIPS, as attractive investment opportunities when the yield between the 10-year TIPS and the 10-year Treasury was less than 200 basis points, implying that expected inflation over the subsequent 10-year period was below the Federal Reserve's 2% target. The TIPS spread is now more than 200 basis points, and so the Federal Reserve is no longer providing a tailwind for TIPS. Therefore, we do not recommend investments in TIPS at this point. The high-yield corporate space looks more attractive than it did at the beginning of the year, as the high-yield spread has widened. The high yield corporate space tends to be lower duration than the investment grade corporate space, which will be an asset in the rising interest rate environment we envision for the balance of 2018. That said, spreads have not widened to the point they indicate concerns about corporate leverage or future economic growth. Shown here, yields are still well below the levels seen prior to the last recession. Thank you for watching. Please feel free to contact us with any questions or comments.